And George, there's been a lot of talk here about some of the economic data we've gotten. I'm not sure if it really changed the narrative, but it certainly seemed to inject a little bit more optimism into this market over the past week. Are you buying into that?
No, I do. I think the issue is, again, as you just mentioned, peak Goldilocks. Things are really good, and we're seeing earnings continue to be strong. We're seeing them broaden out. We're seeing risk appetites looking more broadly. Do I think that there's going to be some retrenchment in terms of where capital is? Could we have some short-term normalization? Sure, but right now the setup is awfully good for equity markets.
Is the inflation story, is that kind of not the story anymore, George, or should we still be focused on it?
I think the inflation story became not the story when we went from an anticipated 6 cuts to 1-ish now, and we're worried whether there's going to be a July or September cut. I think that's been off the table, right? I think there's more of a concern of, is inflation going to be sticky longer term? That's the opening question. I don't think that the inflation part is really what it's going to drive markets, from a true fundamental perspective for a while.
So what drives it, George?
Honestly, I think it's earnings. I'm thinking it's a broadening of earnings. Last year, you saw very strong earnings concentrated in a small handful of companies. This year, you're seeing earnings broaden out across the variety of sectors, with the exception of really energy. You've got strong earnings across the rest of the S&P sectors. I think that breadth is going to help drive markets going forward. And I also think you're going to see it broaden out internationally as well. It's not going to be just U.S. driven. You'll see it broaden out globally.
Before we get to globally, though, when we broaden out here in the U.S., where in particular are we talking about value? Are we talking about small caps? Are we talking about a rotation within the broader S&P?
Yeah, I think, look, again, we're still going to have strength with the Magnificent Seven, and tech and communications will still be good. NVIDIA's earnings, just the latest touch point with respect to that. But you're also seeing, strength in industrials. You're seeing strength in financials, and I think that'll continue to persist. So, again, does that imply that former laggards will catch up, like value, like small caps? For sure.
So when you look at some of the crowding then, George, that we've seen in the equity space, and the idea that, at least in theory, it appears that you're seeing more investors, particularly on the asset management side, the institutional side, looking for something outside the normal parameters of big tech and some of the other, I guess, tried and true names that have taken this rally to where it is. Where do you find that value, so to speak?
So one is within the U.S. or within kind of sectors. Look, I think the commodity and mining space is a very attractive area. And again, a lot of these names have run a little bit this year, but I think there's a lot more to go. And part of the reason there is they're huge beneficiaries, one, of increased infrastructure spend globally, and then moreover, long-term supply shortages that can't get rectified anytime soon. And so it really does set up for a perfect storm positively for that space. And I think folks will go that way. Secondarily is getting outside the U.S. a little bit. Again, the U.S. is still a great engine of innovation, but a lot of that has already been reflected in equity markets. I think you're seeing a lot of, opportunity outside the United States in places where we haven't trafficked before, like the U.K. and even China.
The U.K., really? What's the thesis behind that?
So the UK, less from a domestic perspective, more from an international perspective. The UK is home to many multinational companies, think pharmaceuticals, think industrials, and defense companies and things like that, that have got footprints that are very similar to, let's say, U.S. multinationals, yet same footprint, similar revenue generation, and trade at a substantial discount to their U.S. counterparts, primarily because of a UK discount. And you're starting to see more and more UK firms look to and actively relist in the U.S. and trade up much higher as a consequence. That's an arbitrage that has to be closed, and I think that helps, support an investment case in the U.K.
Also, George, that really pairs with your commodities, because it's a lot of commodities and oil companies and raw material companies that really help that FTSE 100. Where else globally do you feel like makes the most sense? And then how do you pair that with what we're seeing in the FX market?
Yeah, so two things. One, and they're very much kind of a yin and the yang here, right? So one will be Japan. Japan has been strong for the last year plus. We've seen tremendous returns again this year, nearly 30% year to date on the topics. Again, a strong year last year, but you're really coming out of 30 years of a bear market, seeing significant corporate reform, restructuring, positive shareholder moves, and still relatively low valuations in a lot of sectors, especially domestic sectors. And they're benefiting from a very weak yen as well. So earnings power will continue to grow, especially in local currency terms. So Japan continues to be a very attractive place to invest. And then kind of on the opposite side is China, whereas you've had this tremendous momentum in Japan for the last, again, year and a half. You've kind of had the antithesis of that in China, where it's really been a very weak market. You've had 3 consecutive years of negative performance there. I think that's gone way too far. It's now the cheapest market in the world. And while we're doing a lot of on and nearshoring in the West, particularly the U.S., that also creates a lot of on and nearshoring opportunities for Chinese companies as well. And again, given where the sentiment is, which is so overwhelmingly negative, it does set up some really interesting long-term opportunities.
George, when you're making your portfolio allocation and stuff, how much do you look at what fiscal spend is in whatever country you're working in?
So you have to pay attention to the macro environment. I'm not smart enough to be able to predict where the macroeconomy is going. I can't predict the weather. I can't predict the macro, but we are paying attention to certainly what's happening in macro land and whether or not you're going to see stimulative policy, i.e. not only just fiscal spend, but also easy monetary policy. And it's easier to invest in a market where there's going to be more liquidity, i.e. easier fiscal and monetary than when there's not. So clearly a factor that comes into play.